righty, we start today with the comeback rally, weekly jobless claims data, giving a bit of a positive sign for the labor market. So let's bring in Eva Ados, COO and Chief Investment Strategist with ERShares. Eva, welcome. Good to have you with us. Earlier this week, there was a tremendous amount of concern over maybe three things. One was the job numbers that came out last Friday. Two was Warren Buffett selling half his stake in Apple. Three was the unwinding of what's called the carry trade in Japan. Those things now seem to be sort of rearview mirror-ish as the market stabilizes.
Hopefully, I'm optimistic. We think there was an overreaction, and especially yesterday with the weak Treasury sales, we see this today. It's being reversed. We had good news today. The jobless claims came better than expected. That supports our thesis that we have been maintaining for a long time now, that we're not heading into a recession. We believe unemployment is going to remain lower than the historical average. And we need to remember we have 4.4 million baby boomers that are eligible to retire, and that will help maintain unemployment low in the near future and in the next year, too.
Let's talk a little bit, just to push back just a tad there. We see today Eli Lilly coming out and blowing things away. Well, we know why. They've got a blockbuster suite of products. But earlier this week and over the past couple of weeks, we've begun to see more and more companies getting tentative, warning, guiding downwards or guiding to the lower end of ranges. Does that concern you? Because in the end, the stock market is a pricing mechanism for the stream of future profits. And if those profits aren't going to be what was anticipated, neither will stock prices be.
I agree. It's definitely not going to be the best earnings seasons we've had. We do have a 77% earnings beat rate, which is consistent with historical rates. But what's different, as you mentioned, is the profits beat. Companies are beating on average by 4% rate, whereas historically that has been 8%. So this is half what we used to see in the past and historical average in the last 5 years. So this is a concern. It is a stock picker's market. We did see some companies perform well, like Exact Sciences and DoorDash, and we had extreme bad examples like Airbnb. So it's a stock picker's market, and it's definitely a play to look specifically at the fundamentals of the companies and see which ones are using, for example, AI and are able to deal with the situation.
AppLovin, Arista, those are some places you'd look. Eva, maybe you could tell us about those for a moment if there's any others.
These are our favorite right now, and I know AI is so much of a Q1 play, but specifically looking at their fundamentals, these companies are extraordinary, very unusual. In both cases, we have companies using AI to cut their costs, widen their margins, which is very unusual. And in the case of AppLovin, this is a company that has increased its gross margin by 10%. It cut its SG&A by 10%, widened their EBITDA by 20%, while at the same time, they're growing revenues by 44%. This is so extraordinary. There are no companies other than NVIDIA showing such a great momentum, and they're maintaining their sector dominance no matter the market conditions.
Scott Clemons of Brown Brothers Harriman joins us now. Scott, welcome. I want you to explain to this layman what the hell the carry trade is, why it matters, and what's been happening with it and why.
It has sort of an ominous overtone to it, doesn't it? It's pretty simple. It's just borrowing and investing in different currencies and arbitraging the different cost of borrowing and return opportunities. The carry trade at present takes advantage of the fact that borrowing in yen is very cheap, has been very cheap. The dollar has strengthened against the yen. And of course, dollar assets like the ones we've been talking about up until the recent market stumble have done quite well. So there are three ways to win in the carry trade, but there are also three ways to lose. And we've been reminded over the past 5 or 6 trading sessions that all of those trends can go in the opposite direction as well.
In other words, the interest rates in Japan can go up, the yen can strengthen, and so forth, and that would work against the sort of easy money that's been made in the carry trade. Have I got that right?
That's right. That's right, Tyler. Easy money rarely stays that way for long, although the carry trade has been very effective going all the way back to the beginning of 2023. But then the Bank of Japan raised interest rates last week. Of course, our own central bank is talking about cutting interest rates. Stocks have stumbled. The dollar has weakened a little bit against the yen. So it's just a healthy reminder that those trends can go in two different directions.
All right, Scott, glad you were able to join us there for the very tail end. We had a little technical issue. Eva Ados, thank you as well.